Welcome everybody. This is Ellman, the blue-collar investor, with today's covered call writing question of the day, which comes from Jim of Edmonds, Washington. Alan, if the primary market indexes are indicating a sell signal, or if the markets are volatile, should a covered call writer stay on the sidelines? If not, how should he proceed? Well, Jim, a covered call writer should be in the market, of course, when his own personal risk tolerance permits him to. But generally speaking, I'm in the market just about all the time. An example of a time when I wasn't was the latter part of 2008, when we had that severe recession and the market was declining precipitously. But generally speaking, I'm in the market. And there are several things you could do to mitigate risk in the market conditions that you ask about. First of all, you could use stocks that have a very low historical volatility. We look to beta to determine the historical volatility. And on the screenshot that you're looking at right now, you see some beta statistics from our Blue Collar Premium report. Now, stocks with low beta tend to outperform in bear markets. Stocks with higher beta tend to outperform in bull markets. So what we're looking for are betas less than 1 when you have bear or volatile market conditions. Second thing you could do is you could use in-the-money strikes. Now, when you sell an in-the-money strike, you're still getting good time value or profit on the option sale, but you're also generating an insurance policy that the option holder pays for. In other words, you have downside protection of the option profit. Now, as an example, I'm showing a screenshot in front of you right now with a stock that was currently selling for $22.34. You could see I highlighted 3 strike prices, an in-the-money 20, a near-the-money, and an out-of-the-money strike price. So we're going to focus in by the red arrow for the in-the-money $20 strike price. Here you could see a premium of $3.10. Now, the time value of that premium still represents a 3.8% one-month return, and the intrinsic value gives you a 10.5% protection of that profit. So in a bear market, that would be considered by many to be a great covered call writing trade to make. The third thing you could do is you could utilize exchange-traded funds. Now, these are securities that are like mutual funds but behave like a stock, and many of them have options associated with them. They are, because they're a basket of stocks, they represent a lower risk level. Now, in the screenshot in front of you, I'm showing you page 1 of our Blue Collar Premium ETF reports, which shows 3 such securities which are outperforming the S&P 500, and all meet one of our criteria of having a relative price strength greater than 65. The fourth thing you could do is to use exit strategies that are consistent with bear market situations. And that would include rolling down, where you buy back the option and sell a lower strike price, or closing your entire position, converting dead money to cash profits, where you unwind your position and use the cash to enter a new one when the price of the stock declines and you've pretty much had it with that stock. You can also use rolling strategies at the end of the month consistent with bear markets, which would be to roll out as opposed to rolling out and up. So if your risk tolerance permits you to trade in bear market or volatile market conditions, I've just given you 4 different approaches you can make to mitigate the risk in these kind of market conditions. And most of the time, they will lead you to some very nice profits despite the way the market is headed. So I appreciate the call very much, Jim, and I appreciate the contact. It's a very important question. Many of our viewers asked this question, so I decided to include it in the Ask Alan series. I thank you, and I thank all of our viewers for watching this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.